So we must be live here. Let's see. I'm so dumb because I actually started the live on my other channel, my Greek channel. It was the dumbest move I have ever done. I forgot to change the stream key and the live stream opened on the wrong live basically. Anyway, let's go back to what we were reading. We were reading this article. We talked about how the futures are doing on the last live stream that I started on the wrong channel. Anyway, I hope it. I tried to delete it as fast as possible. It was a mistake. Anyway, right now things are looking kind of nervous. People are kind of nervous because today everyone has this date marked on their calendars because it's the release of the CPI data, of the inflation reading that we have. So the S&P right now is 0.1% down, Dow 0.05% down, Nasdaq on the other hand 0.35% down. Nasdaq turning more negative today. Let's see how things will play out. I don't think today will be such a negative day somehow. That's what I feel. That's what I believe. Last day we had a confident relief rally from the lows that we have seen after a 4-day losing streak. We picked back up, and I don't think it can get any much worse than this for stocks because we are still on this long-term upper sloping trend on this bull market. We still haven't failed with that one. So we have some dips here and there, but it mostly seems like we are recovering from every single one of them. And I guess it's very hard to break a trend like this. And I guess we will keep on going with that. So the market has just opened. Let's go very quickly. We were reading this article before, but let's just jump into stocks right now really quick. And from there, we'll move on back to this article. Let's close this thing. I don't even know what it is. So let's see. So Google recovered. Last day I was buying Google all the way at 2680, 2670 and 2690. I bought a lot there. I'm happy about that buy. And it seems like we have recovered today and we're up 0.5% for the day. I don't know whether this will hold or not. 2750 are still good prices for Google. I mean, that's like 25 PE for Google. 2750 is like almost 25 PE, which is great for a company like Google, which its ad revenue can still increase a lot. I want to buy some Amazon here today, probably later today. Let's see, should I buy now? The lower we get on this accumulation period, the better. But it's almost like we're forming another, oh, that's wrong. It's almost like we're forming another support line here. Look at that. It's almost like it has touched almost 4 times. Of course, it has spent time here, but it has touched 2 times here, 1, 2, and got close 2 times. So this is still a good price to buy. Maybe let's buy some Amazon, just €2, just DCAing just a bit into Amazon because my order didn't fill before. Besides that, we have Etsy here. We have Enphase. Those stocks recovered a lot from the last lows that we had on the other day. I think Etsy went as low as 170 or something, 174 or 170. Yeah, 170, 172. Enphase went as low as 139. And those were good prices. Like my average price is 141. Of course, I don't have big positions on Etsy or Enphase, but I like the stocks because of Mid-Kevin mostly. Besides that, Tesla, $1,053 per share. Redfin is at 34, Affirm 78. I'm not a big fan of Affirm. On the other hand, let's check Hood. Hood negative again. Okay, Honest is absolutely flat, open flat. Interesting for Honest, very beaten down stock. Same thing for SoFi, beaten down too. We're sitting right on top of my average price per share. Interesting. Tarot Chef below $14, very depressed as well. So all these stocks had a very hard time last day, and the last couple of, basically the last week was the one that dropped them below the all-time lows that they have, the 52-week lows that they have, and things are looking scary for the stocks. But after a bad time, there can only come a good time. So I'm staying positive. I'm DCAing in all of the stocks: SoFi, TTCF, Honest. I like the stocks, and things will play out for the better. I want to DCA into Monster Energy too, so let me buy here just €2.5. I DCA into this company every day for like €1 or €2. Pepsi on the other hand is another stock I like, but have left on the side for now because of its very high PE relative to its historical PE. Adobe 524. I think Adobe dropped below 500 for a brief moment. Whew. Oh, sorry. Let's check the live stream if it's working. It was fun. It was funny. No. I have to. This is not my new haircut. My haircut is in like 1 hour. In 1 hour, I'll go get a new haircut. I'll be fresh AF. Besides that, let's move on. Things are looking kinda slow for the day. Let's go check the futures again. S&P is still looking negative. Nasdaq recovering a bit. The indexes are extending their losses. S&P is 0.3% down, Dow 0.45% down, Nasdaq 0.4% down as well. Okay, so we see tech stocks taking it almost looks like they're about to take a hit today again. Besides that, let's go to check the markets a bit, the crypto market. We see some weakness. The last day we saw the biggest dip of Bitcoin. We dropped where we dropped below 40k. We saw it at the time of the open. So, and we see some weakness again. We were bouncing around 42k, and now at the market open we are now at 41.3k again, and we are slowly grinding lower. That's interesting, the fact that we are seeing weakness along with the stock market at the same time, at the exact same time. 3,100 for Ethereum. We have Bitcoin here at 41.4k. Okay, let's see. Those ADAs at 114. Chainlink has recovered a bit. Chainlink almost was at the second page for a while, and below $20, and now it's back to 26. I love Chainlink for the long run. Matic on the other hand, 220. It looks like it's very strong around that price, and it might be an opportunity to buy Matic at $2 if it drops there again. Let me put on maybe on my phone. Where's my phone? Oh, it's on the other desk. Maybe if Matic drops below $2, I might be interested to buy some. Let's see. Can I set a price alert here? I think I can't set a price alert from the PC, but I can set a price alert from the phone. So I'll probably do that later. If Matic drops again at $2, look at that. It has a very nice support line at this 99-day moving average, and it has held on it for a lot of time actually. And it completely did the same thing. It completely bounced and did the same thing. Used this 99-day moving average as a support line. That's nice. Let me check if I have any comments. Okay, brother, tell for Avax coin. Avax is a DApp platform, a decentralized app platform. It aims to be decentralized, but nothing is as decentralized as Bitcoin or Ethereum. Some people are even skeptical on ADA being decentralized because of its nodes. But yeah, Avax tries to be decentralized, and it aims to be a decentralized app platform to deploy smart contracts like Ethereum, Cardano, or Solana. And it's actually good at that. It had actually really good how can I say that? It had many active users on its that platform, but people are kind of losing their interest in Avax a bit. Not so much, but at this price, is it the best time to buy Avax? Not really. Is it the worst time? No, it's not. It's definitely, if you would like to have a position on Avax, you can DCA a bit into Avax at those prices. Let me see real quick. Its chart. I think the high when I was covering Avax on the last live streams, I was selling the prices. The highest that it got was 140. Yeah, the highest that it got was 148. It got all the way to 148. So that's almost double what it is now. Almost like 35 billion market cap. Right now it is a market cap of 20, around almost as big as Dogecoin and Polkadot. I wouldn't buy Avax at those prices. Let's see how low it went here. It went as low as 79. It's not that expensive actually. Avax is not that expensive, but I would prefer to invest into Ethereum or maybe DCA bit into ADA. Because look at that. AVAX has a high of 150, has an all-time high of 150. Right now is at $85 per share. That's like 40% down. Let's see. Let's count. 150. Is this? No, is that the wrong number? What the fuck am I doing? 85, 150. It's 56% down. AVAX is 56% down. But if we go and check ADA, Cardano, this will be interesting. Stay around to see that. Cardano has an all-time high of 315. If we go and check the price for, so AVAX is 56% down. Cardano 3.15, and right now is 114. Let's see how down Cardano is. Oh, wrong again. 114. Oh my god, I can't do the 1.14. 3.15. What the fuck am I doing? I can make the... I'm doing something wrong. Anyway, Cardano is more than 60% down. More than 60%. I think that's almost 75%. 75% down. Like 70% down. 70% down. So AVAX is down like 50 to 60%. Cardano is down 70% from its all-time highs. So I guess it's more worth it maybe now to DCA into Cardano relative to AVAX. AVAX is kind of overvalued. Not overvalued, but it's not as beaten down as ADA is. So you can say that ADA will recover more if you believe in ADA and its fundamentals. But yeah, I wouldn't invest in AVAX. I have a position on Cardano. I DCA'd a bit into Cardano, but I haven't bought more AVAX. That's it. I once tried to open a position on AVAX, but I didn't feel like holding this coin. This coin. Maybe it's because I don't use the how is it called? The online, basically the DApp platform. The DeFi that it has, the DeFi that's happening on AVAX. Maybe because I don't use that, I don't believe, that makes me not believe that much into AVAX. But anyway, Bitcoin right now is at 41.4K, Ethereum 3.1K. Let's go back to the stocks for a bit. Let's see here. Google, we see some weakness here, but it's trying to hold its gains. Probably the only positive stock. Look at that. Google is the only positive stocks right here right now. On the other hand, we have Twitter, PayPal. PayPal trying to recover from its lows. Alibaba. I have a big position on Alibaba, and it looks like it's trying to recover from the all-time lows that it has. These prices were insane. 110 were insane for Alibaba. I'm very happy it's recovering after so long holding that stock being negative. We have Enphase here. Etsy, so the stocks seem kind of weak again. I wonder whether they will extend their losses or what will happen next. It will be kind of interesting. We have SoFi here, Tarot Chef. SoFi is flat right now. SoFi is actually 1.4% down. Tarot Chef is 4% down for the day. Is that right? 4% down for the day, or it hasn't loaded yet? Anyway. Oh my god, why do you say oh my god, Degas? Anyway, let's maybe watch a video or two. I had opened here on CNBC, there was a story. There was a story here. Goldman David Costin says a tech disconnect is the single greatest mispricing in US stocks. This guy believes that a technology stock derating likely has further to go. He believes that stocks will drop even more. By the way, tomorrow is a big day. Tomorrow is a big day because the CPI data, the inflation reading data is coming out. Basically how much inflation we have, and inflation is definitely impacting the markets. Maybe long term in a positive way because it pushes the asset prices up, but what impacts the markets negatively is the raising of the interest rate. So if they raise the interest rates, that pushes the stocks down. That's one thing to keep in mind. Anyway, give me a minute here. Let's watch this video together.
That if 10-year treasury,
what this guy talks. He said, by the way, it says here that The US tech sold off sharply in the first week of the year, taking the Nasdaq 100, the index of the technology stocks basically, nearly into correction territory. Briefly on Monday before rallying to snap a 4-day losing streak. Analysts broadly expect 2022 to be a tough year for high growth tech names that have benefited from ultra loose monetary policy, necessitated by the COVID-19 pandemic as the stimulus unwinds. The reason that people are nervous for 2022 when it comes to stocks is because, do you know Spiros Panopoulos? Spiros Panopoulos, no, I don't know that guy. Do you want me to look for him, to learn about him? I don't know him. The reason people are nervous for 2022 is because the Fed made them nervous. The Fed said that they wouldn't raise the interest rates. They wouldn't raise the interest rates until 2023. And then after a week or two, they come out and say that they will raise the interest rates on 2022 2 or 3 times. So of course that makes the markets nervous and makes everyone second guess what they do. Anyway, let's watch this video together while I take a look at more stocks.
Between equities and rates is a function of the speed of the backup or the increase or decrease, because it kind of is there's a symmetry to this, but the speed and the magnitude of the change in interest rates. So very specifically, if we think about changes, modest changes in the 10-year treasury yield, for example, not necessarily have a huge impact on equity prices. However, once you get a move that in sort of statistical terms around 2 standard deviation move, that's usually a tipping point. So let's put that in terms for current investors. A 2 standard deviation move in 1 month, 10-year US Treasury volatility is around 37 basis points. That is to say that if the 10-year Treasury yield rises by around that level, by that magnitude in a month, that would be a highly unusual, a very significant move in the market, and that would be typically associated with a decline in equity prices. And of course, that is what we saw last week, first week of the year, dramatic increase in rates over, not just in the 1 week, if you want to isolate that just to say 5-day trading period, but even over the past month. That magnitude of increase is quite significant, and that's pretty much hit that threshold. And so that would be consistent with what we've seen in a decline in equity prices. Now, very specifically, the single greatest mispricing in the U.S. equity market is between companies that have high expected revenue growth, but low or negative margins. On the other hand, high growth companies with positive or very significantly positive profit margins. That gap is adjusted dramatically in the last year. Put some numbers around that. High growth, low margin stocks traded at 16 times enterprise value to sales February of 2021. 11 months later, they're trading at 7 times. So a huge derating that took place. Much of that took place in the last month or so. And largely that's because as rates increase, the valuation or the value of that future cash flows are worth somewhat less in a higher rate environment. And that's a big issue. And so the gap between those two, I'd say, is the single biggest topic of conversation with clients. You've had a huge derating of the
Look at that. Listen to what he says here.
So a huge derating that took place. Much of that took place in the last month or so. Gap is adjusted dramatically with positive or very significantly positive profit margins. That gap is adjusted dramatically in the last year. Put some numbers around that. High growth, low margin stocks traded at 16.
So what he says here is that stocks that were considered high growth, that had like more than 30% growth year over year when it comes to revenue, for example, but had low margins. They had low margins, their margins weren't that high. Those stocks, when they were trading at one point at 16 times, for example, forward sales. And then after a while, they corrected a lot. And now they are trading at only 7 times forward sales. Listen to that.
Times enterprise value to sales February of 2021. 11 months later, they're
enterprise value to sales, and then 11 months later they trade at only 7 times enterprise value to sales,
trading at 7 times. So a huge derating that took place. much of that took place in the last month or so. And largely that's because as rates increase, the valuation or the value of that future cash flows are worth somewhat less in a higher rate environment. And that's a big issue. And so the gap between those two, I'd say, is the single biggest topic of conversation with clients. You've had a huge derating of the fast expected revenue growth companies that have low margins. And the argument is probably that there's more to go in that readjustment. The relationship between these two categories, these two buckets of stocks, are are still pretty close to one another and probably should be wider.
So he believes here, as the interest rates increase, the value of those future cash flows, of the money, of the revenue that those companies have, is worth less because the interest rates are higher. So because it's worth less, that pushes the stock prices down for those tech stocks that were high growth but low margins. And he believes that there is more to go. He believes that there is more to go. So there is more pain to go according to this guy, for stocks like this that are high growth but low margins.
Could go different directions. It could be that some of the companies that have fast growth and also high profit margins increase in their valuation, or perhaps lower prices for some of the others which have.
Anyway, we heard that story. We heard about what he said. So I don't think he has anything else to add. Let's hear about this. Plenty of risk, but analysts are skeptical on a serious stock market downturn. The reason we spent time reading about the stock market is because it matters. It matters. And over the last couple of weeks and months, we have seen some correlation between the stock market, the Nasdaq, maybe the S&P, and Bitcoin and the crypto market. And we know what happens on Bitcoin affects every other crypto. So that's why you pay attention to all these things. Last week, let's read this article. Last week saw US equities endure their second worst start to a year since the Lehman Brothers collapse, driven by further hawkishness from the Federal Reserve and a sell-off for highly valued US tech stocks. The rapid spread of the Omicron COVID-19 variant around the world has also been a persistent cloud over the equity outlook in recent months. Despite this, analysts largely do not foresee a serious correction in 2022. Okay. Let's watch this video together. So this guy here.
Well, good morning, Steve. Yes, the numbers.
Inflation expectations.
On Friday. I mean, I like the numbers.
He believes that inflation won't accelerate as much.
The wage numbers, but for a different reason. I mean, I know you're speaking about the fact that wages are going up by less than prices, and that means that real incomes should have downward pressure from decaying real wages. And that is one consideration of the numbers. But seen through a different lens, I look at the 4.6% increase in wages that were reported, and I look at forecasts or current 6%, 7% increases in CPI, and I say to myself, how can we forecast continued increases of prices at this pace?
Stocks are recovering, man.
As low as they are.
Stocks are recovering.
And I just can't get there from here. So we're coming out at High Frequency Economics on the bullish side of the inflation outlook, looking for less inflation than the Fed and the market, and expecting that expectations for accelerating inflation are going to be disappointed.
Yeah, but those who have been very, very wrong about inflation, and I would like to say this channel has had a very widespread of opinion, should we put it that way? But those who have been wrong are now saying, oh, it's going to come down aggressively. Well, even if it comes down, Carl, it's still going to remain above that 2% level, which is actually the target. We seem to have lost touch with the fact that we are around about 5 percentage points above where the target is. I appreciate that inflation might not run as hot as 7%, as we're going to see later on this week, for long, but it's still going to be above target, isn't it?
Well, you know the old story, Steve. Past performance is no guarantee of future results. We've seen some specific supply constraints in specific sectors that have been pushing up that headline and core CPI numbers. The cars come immediately to mind, with the chip shortage reducing the supply of both new and used cars to the market. We've seen energy prices in the headline number, which have been generating these very extraordinarily high headline figures. These are all going to work out of the maths. And what was a doubling of oil prices as recently as October is going to reduce to a 25% year-over-year increase in oil prices by the time we get to February, March, and go away altogether by the end of the year, unless oil prices double again, which is not our forecast at High Frequency Economics. So I think we can understand where we are, and understanding where we are, we can see that things are not going to continue as they have been in the past. So we shouldn't expect these special factors pushing up prices to continue.
But Carl, I think as we all understand here, the question is not so much what we feel about this, it's how the Federal Reserve Committee thinks about the employment conditions at this stage. And I do wonder, will the Fed be more focused on the 3.9% number and argue that that represents full employment instead of maybe getting hung up on the sluggish payrolls number?
Well, Jeff, I think you're absolutely right. Right now, the Fed is very focused on inflation. It's very focused on responding to the numbers that are being printed. So I agree with what both you and Steve are saying, that the numbers have the Fed's attention. And yes, we do expect the Fed to react to those numbers in the near term. We're expecting that they will hike rates in May and then again in June. But as they are hiking rates, we expect to see both the inflation numbers and the growth numbers for the economy deteriorate. And as they deteriorate, the impetus for the third, and now people are talking about a fourth hike in rates later in the year, I don't think the pressure is going to be there by the time we get to that point. So that means for markets that we're probably going to see the yield curve steepen in the very short term and rise in the very short term. But that movement in the yield curve is going to very, very quickly as the year progresses fade away, and that the curve will flatten out and bond yields will retrace as inflation doesn't deliver the expected result.
So we heard that story too, even though I was not that interested to it. Let's watch this video. There was a video that I opened. Was it here? Yeah, it was here on Yahoo Finance. Oh, when it comes to Apple, it has to do with Apple. Apple is still bigger than all these companies combined. Is that the story? The top 50 stocks by market cap in the S&P. Oh, that's an interesting.
Back over to Yahoo Finance's Jared Blickery with one last thought on the markets. And Jared, you're looking at Apple.
That's right. 1 week after it hit $3 trillion in intraday market capitalization, is very brief, decided to kind of take a look at Apple. It's only down about 6.5% from its record high, which was 1 week ago as well. But I'm writing this up for tomorrow. I'm writing up this article for tomorrow, and I do have some visuals on the Wi-Fi Interactive. So I took the top 50 companies by market cap in the S&P 500, and you can see them on your screen if we can get the Wi-Fi Interactive up. There we go. And in the center, we got Apple here, surrounded by Microsoft, Alphabet, Amazon. And I'll say that Berkshire Hathaway is in there too. Apple is bigger than Berkshire Hathaway, Meta, which is now Facebook, and Tesla combined. And it's pretty interesting if you take a look and you break it down by sector. So all of these put together, $23 trillion. That is bigger than the market cap of most countries. And here's the tech sector by itself. Tech is the most commonly represented here. We got 14 companies, and they bring $8.6 trillion in value to the sector. Besides Apple and Microsoft, you're seeing NVIDIA, Qualcomm, Adobe. So you got some software names in there, semiconductors. Visa and MasterCard, they're also in there. They may be migrating to the financial sector. Sometimes these classification systems, and there are many, we're using the GICS one. Sometimes these are a little bit non-intuitive. And you kind of see that in communication services, because that's where we have Alphabet, Facebook, Netflix, Comcast, Disney, Verizon, all those companies, and AT&T, all those companies put together, that's $3.8 trillion. I'm going to go through the rest of these kind of quickly, but just to show you consumer discretionary, we got Amazon, Tesla, and Nike in there. Then we have financials. Financials account for $2.2 trillion. We got Berkshire Hathaway, JP Morgan, Wells Fargo, Morgan Stanley, Bank of America too, that's up there as well. And then we have healthcare. A lot of the big names, James is in there too. Coca-Cola, Costco.
Costco is getting bigger and bigger by the day, man.
Procter & Gamble is in there too. Coca-Cola, Costco. And then we have
Costco will probably outperform all, even though Costco had a huge year for 2021, it will probably outperform all these ones. Maybe it will fight with Pepsi, because Pepsi is on a big upper sloping trend too, and it's growing a lot. But yeah, Costco, it's funny, but I was telling you that I sold at 540, 550, and the stock came all the way back to correct, and I think it's still considered overvalued. Look at that. At 575, its P was like 60, was like 60, 70. That's a very high P, an ultra high P for this company, for this type of company. So it had to correct, it had to drop. I'm lucky, I was lucky I took some profits and got out of my position early, but yeah, I think it will drop even lower. Anyway, that's all for this market live stream for today. Things are kind of slow, and I'll see you guys the rest of the day. Maybe I'll do a recap of my portfolio later.